What is up, everyone? My name is Rose and welcome back to my channel. This video is all about calls and puts 101. It's an options kind of beginner basics 101 video. This video is the second video in a 6-week series where I talk all about options trading for a side hustle income. And so if you haven't subscribed already, make sure you do so you don't miss any of the future videos in the series. So in this video, I'm going to explain what options are, how they work, plus show you lots of examples so that you can really understand. And that way, by the end of this video, you should have a solid understanding of what options are and what to do with them. Now, fair warning, it takes a bit of effort to understand options and really wrap your head around them. But it's worth it because there's a lot of cool things you can do once you understand stock options. Like you can trade them for a few minutes a week, generate a nice flexible side income, which is actually something I talk about in this video right here. But you don't get to that point overnight. First, you need to put in a little bit of time and effort to first understand the basics. I'm gonna first explain what an option is, then I'll explain the difference between the two types of options, calls and puts, and finally, I'll talk about how you can make money with options. We have a lot to cover, but you can do this. Grab a notebook to take notes with and just stick with me, okay? Ready? Let's do this. Let's start off with what an option is. To start understanding options, a useful starting point is to compare it to something that you already know, stocks. So buying and selling options is a lot like buying and selling stocks, but with a few key differences. So here's a price chart of Apple stock. If Apple is currently trading at 145, but you think it's going to go up, what you can do is you could just buy the stock for 145, wait for it to go up, and then hopefully sell the stock at a profit. If you are right and Apple does go up to say $200, then your profit would be $200 minus your purchase price of 145, making a $55 profit. On the flip side, let's say you're wrong and Apple actually goes down to maybe $100. Then your loss would be $100 minus your purchase price of 145, which makes a $45 loss. Essentially, when you buy a stock, your profit and loss is linked dollar for dollar to the movement of the stock price. So if Apple goes up $1, you make $1. If Apple goes down $1, you lose $1. If Apple goes up $100, you make $100. And if Apple goes down $100, you lose $100. So you get the picture. This diagram illustrates the relationship between your profit and loss as a purchaser of the stock versus the stock price. So if Apple goes up to say $200, then your profit on the trade, assuming a $145 purchase price, is $55. And now if Apple goes down to 100, like we covered in the example, then your loss on the trade, again, assuming that $145 purchase price, is $45. So notice that this profit and loss line is a straight line, reflecting that one-for-one relationship between your profit and loss and the stock's price. So that's how it works when you buy a stock. Now let's talk about how it works when you buy an option. When you buy a stock option, what you're buying is the right to transact on a stock at a specific price before some predetermined expiry date. So what if instead of buying Apple stock for $145, you bought the option to buy Apple stock at $145? So it's kind of the same thing, but slightly different. Now, this type of option where you're buying the right to buy a stock at a specific price is called a call option. So let's say this call option costs you $5, just pulling numbers out of thin air here. And this call option gives you the right to buy Apple for $145 at any time before the option's expiry date. Wouldn't you agree with me that having the right to buy Apple stock for $145 is gonna be quite similar to actually buying Apple stock for $145? So the profit and loss scenario of buying the stock directly versus buying the Apple call option are going to be very similar. And I'm gonna show you in just a minute, so stay with me. If Apple goes up to $200, as the call option buyer, that is good news for you because this option gives you the right to buy the stock for $145, which is also referred to as the strike price in options lingo. If you own a contract that allows you to buy something for $145 when it's worth $200 on the open market, you're gonna be happy because now what you can do is exercise your rights within the option, buy that stock for $145, and then just turn around and sell it right back to the open market for that higher price of $200, resulting in a $55 profit. One more detail. Since the call option costs you $5 to buy in the first place, you also have to account for what you paid for that option. So after everything is said and done, your net profit would be actually $55 minus $5 for a net profit of $50. So you always have to factor in the cost of the option that allowed you to generate that profit in the first place. So you essentially would have bought Apple stock for $145 and sold it for $200, except that you did it in a more roundabout way by using this call option instead of buying the stock directly. So that's how it would play out if Apple stock went up. What about if you bought a call option and Apple went down? So if Apple goes down to say $100, then that's bad news for you because you already paid $5 to buy this option and it gives you the right to buy the stock for $145, but Apple is trading at $100, so you're obviously not going to want to exercise the right to buy for $145. Why would you want to pay more for something than what it's actually worth on the open market? You wouldn't. No one ever wants to pay more for something than they can get elsewhere. So this call option in this case would be considered worthless. Here's where it gets really interesting. Remember how if you'd purchased Apple stock at $145 and then it went down to $100, then your loss would have been $45? Well, if you'd actually purchased the Apple call option instead of the stock, and then the stock went down to $100, your loss wouldn't be $45 in this case. It would only be $5. Why $5? Because you paid $5 to buy the option, and then the option ended up being worthless because the stock went down. So all you lose is what you paid for the option and you can just walk away. This diagram illustrates the profit and loss of what that options trade would look like. If Apple goes up to 200, then your option becomes valuable. The profit on that trade is $50, which is the difference between Apple's market price of 200 minus the option strike price of 145 less the $5 that you paid for the option. And if Apple goes down to 100, then your loss on the trade is just $5, which is what you paid for the option. Now, even if Apple goes down to $0, like the company goes bankrupt and the stock becomes worthless, then your loss is still just $5. So the potential profit versus the potential loss with an option, it looks kind of like a hockey stick versus a straight line, where your loss would be capped at $5. It's always capped at what you paid for the option and nothing more, but you still get all of the potential upside. When you buy a stock, on the other hand, your upside and downside is directly tied 1-for-1 with the price of the stock, following that straight line relationship. When you buy an option, your upside is directly tied 1-for-1 with the price of the stock, but your downside is not. Your downside is fixed. It's limited to whatever you initially paid for that option, and you'll never lose more than that amount. So that brings us to the key difference between trading stocks versus trading options. Compared to stocks, options have an asymmetrical payoff profile. In other words, limited downside with unlimited upside. However, there is a trade-off to this because options aren't free and they have an expiration date, which means that if you are right, you'll make a bunch of money, that's great, but you also have to get it right within a specific time frame, and that is actually hard to do. So when you buy an option, you have to get the market direction right and you have to get the timing right, which means you have to get it right and you have to get it right quick. Most people who try to do this end up just paying a lot of money to buy options that end up expiring worthless. Either that or the stock price doesn't move enough before the expiry date in order to make up for the cost of the option, let alone leave you with a profit. This is what happens to a lot of options trading beginners. That is why buying options overall is a long-term losing strategy, and statistically, you have a better chance at winning as an option seller versus as an option buyer, especially if your goal is to create consistent cash flow. But that is a topic for another video. For now, I want you to really wrap your head around calls and puts first. You gotta start with the foundation. We touched a little bit on call options earlier, but let's actually do a detailed breakdown on how a call option works. A call option gives the buyer of the option the right to buy the underlying stock at the strike price anytime on or before the expiry date. Here's an example of a call option on Apple, where the underlying is Apple stock, the strike price is $145, the expiry date is August 20th, 2021, and it is a call option. And although you can't see it on here, let's just say the premium or the cost to buy this call option is $5. So you call that the option premium. To visualize how this contract works, let's say there's two parties. Justin is the buyer of the call option. Jacqueline is the seller of the call option, because obviously if you buy something, there has to be someone to sell it to you. And so Jacqueline, she's just writing the contract. She's creating the obligation and telling Justin that in exchange for $5, where he pays her $5, she will take on the other side of this contract that allows Justin to buy Apple stock at $145 anytime on or before the expiry date of August 20th. So he doesn't have to buy Apple at $145, but he just has the right. And if he does exercise that right, Jacqueline has to be on the other side of that trade, meaning if Justin wants to buy Apple at 145, Jacqueline is the one who has to sell the stock to him at 145. So to summarize, Justin is the one who has the right to buy, Jacqueline is the one who has the obligation to sell. And in exchange for this agreement, Justin pays Jacqueline $5 in premium, and Jacqueline is the one who collects that $5 in premium. So she's getting compensated for taking on the obligation, and Justin is paying money in order to have the right. Let's see how this shakes out if Apple goes up. So this is the profit and loss profile for if Apple goes up to 200. So this horizontal line is the stock price. So if Apple goes up to 200, what do you think is going to happen? Obviously, since the call gives Justin the right to buy Apple at 145, and if Apple's actually trading at $200 on the open market, he's going to be really happy because everybody loves a good deal to buy something at lower than what it's actually worth. So he's going to exercise at 145 and probably turn right back around and sell it on the open market for 200. So he's going to pocket an immediate $55 difference between his strike price and the market price of Apple. So that makes a $55 profit, but you also have to factor in the cost of the option, the $5 that he paid to have this option in the first place. So that $55 profit minus $5 for the cost of the option leaves him with a $50 net profit. So this is always the formula for calculating the profit of a call buyer. It's the market price of the stock minus the strike price of the call minus the cost of the option or the option premium, and that equals your net profit. And notice how it's a diagonal line. The higher the stock price goes, let's say it goes from 200 to say 300 to 400, 500 to 1,000, then his profit is going to just keep going up and up and up. When the stock price goes above the strike price and it gives the call buyer the right to buy something at much lower than what it's actually worth, that's what you call in the money. So in options lingo, this call is in the money. Let's see what happens to the call seller. Logically, since the seller is the opposite side of the buyer, it's going to be sort of the mirror image. So notice how the call buyer's payoff profile looks like this, like a hockey stick, and the call seller's payoff profile looks very similar, except it's flipped upside down. So whatever the call buyer makes, it's the call seller's loss. So if the stock goes above the strike price, then the call seller, remember Jacqueline, she has the obligation to sell Apple at 145 to Justin. And she's not going to be very happy because she's going to actually have to get that stock from somewhere, right? She's going to have to buy it on the open market for 200 and then sell it to Justin at 145, locking in an immediate $55 loss. However, you also have to factor in the cost of the option premium that she actually received. So that's going to offset her loss. So that would be 145 minus 200, which is minus 55, plus $5 for a net loss of $50. And the payoff profile goes down diagonally, meaning the more the stock goes up, the more she's going to lose as the call seller. So when a call is in the money, that's good for the call buyer because you get all of this. And when the call is in the money, it's bad for the call seller because your P&L starts looking like this. Okay, moving along, let's see what happens when the stock price actually goes below the strike price. So in this scenario, let's say Apple went down to 100. The strike price is 145, Apple went down to 100. So Justin, who's the call buyer, he has the right to buy Apple at 145. But the stock actually went down to 100. So he's obviously not going to want to exercise his call option because why would you exercise the right to buy something at 145 when it's actually cheaper elsewhere? So he's not going to exercise his call option. It's just going to expire worthless. This option that he paid money for didn't do him any good. So he's just out $5 and that's it. He walks away, nothing happens. He just loses the $5 that he paid upfront for this option. Now, when the stock price is below the strike price for a call, meaning exercising that call would not be beneficial, then that's what you call out of the money. So in options lingo, this call is out of the money. When a call is out of the money, that's actually good for the seller of that call because What's going to happen here is the call buyer is not going to exercise the option, and therefore the call seller doesn't have any obligation to fulfill on, and she's going to walk away with the premium that she collected up front of $5 to sell this option, and she just walked away. That's it. So when a call ends out of the money, meaning the strike price is higher than the market price of the stock, that's good for the call seller and it's bad for the call buyer. Okay, so to summarize the difference between buying a call versus selling a call, if the stock goes above the strike price, then as the call buyer, that's going to be your profit zone. And the more the stock rises above your strike price, the more profit you make. And then for the call seller, their profit zone is if the stock is going down below the strike price. So it's the opposite as for the call buyer. Buying a call is a bullish trade, meaning it benefits from the market going up, whereas selling a call is a bearish trade, meaning that trade would benefit from the market going down. Give this video a thumbs up if you are getting this. It is a lot to wrap your head around, so don't feel like you have to get it all on the first go around. Feel free to pause this video, think through the examples, and rewatch it as many times as you need. It does take a bit of repetition to really wrap your head around this. Also, if you like having something hands-on to study, make sure to grab a copy of my free options trading starter kit. It's got all the definitions we're talking about, plus some good little diagrams, printable cheat sheets, and little quizzes to test your knowledge. So click the link below to download it. Okay, now let's talk about put options. A put option gives the buyer of the option the right to sell the underlying stock at the strike price anytime on or before the expiry date. Here's an example of a put option where the underlying stock is, again, Apple. The expiry date is, again, August 20th, 2021, and the strike price is $145, except this time it is a put. Once again, let's say Justin is the buyer of this put option and Jacqueline is on the other side of that trade as the option seller. In other words, she's the writer of that put option. What this means is Justin is going to have the right to sell Apple stock at $145 at any time on or before the expiry date of August 20th. And if he does exercise that right to sell, then Jacqueline is going to be obligated to buy that stock from him at $145. Because if he sells, somebody has to take the other side of that trade, and Jacqueline is the one who signed up to do it. So to recap, Justin is the one who has the right to sell because he bought the put option, and Jacqueline sold him the put option, so she's the one who has the obligation to buy the underlying stock should Justin choose to exercise. And since Justin is buying a right, he's buying a privilege, and Jacqueline is taking on an obligation, she's going to collect $5 in premium, and Justin is the one who's going to pay her that $5 in premium. Let's actually visualize what happens when the stock moves. Let's say Apple actually goes down below the strike price of $145. So if Apple goes down to 100 and Justin has the right to sell Apple at $145, he's probably going to be pretty happy because if something's worth 100 and I get to sell at 145, I'm stoked because that means I get to pocket an immediate $45 profit, right? So his profit is going to be 145 minus the underlying market price of $100 minus the cost of the put option, $5, which leaves him with a net profit of $40. So for a put buyer, his profit always follows this formula where it's the put option strike price minus the current market price of the underlying stock minus what he had to pay to own that option in the first place, which leaves him with his net profit. So notice how it follows a diagonal line. The lower the stock goes, the higher his profit gets. But you do need to note that since a stock can't go below zero, his profit is capped. So he'll make the max amount of profit if the stock goes to zero and he gets to still sell at 145, and that will cap his profit right here. Let's see what happens to the put seller. Oh, but before I move on, let's talk about options lingo of in the money and out of the money. If a put option gives the buyer the right to sell at higher than where the market currently is, that put option is what you call in the money. So since his strike price is 145, but the current market price is 100, his put option is in the money, meaning exercising that option would generate a bit of a profit for him. So if a put option is in the money, that's good for the put buyer, but logically that would be bad for the put seller because their profit and loss profile is going to be the mirror image. So if Apple goes down to 100, what's going to happen is Justin, the buyer of that put, he's gonna exercise his right to sell Apple at 145, and the put seller is gonna be obligated to buy that stock from him at the strike price. So if you were the put seller and you had to buy a stock at 145 when it's actually worth a lot less, are you gonna be happy? Probably not, right? Why would you wanna be obligated to buy something at 145 when it's actually worth a lot less? But that's the risk and obligation that you took on when you sold the put in the first place. So Jacqueline, the put seller, will be obligated to buy at 145 and probably have to sell it back to the market at a loss. So that means an immediate $45 loss for her. But of course, since she did receive $5 in premium upfront, that's gonna offset a bit of her loss. So here's the formula for a put seller. It would be the market price of the underlying minus the strike price, offset a little bit by the option premium that she received for a net $40 loss. This is what happens when the put ends in the money. The put buyer ends up with a profit, the put seller ends up with the equal amount but opposite amount of loss. Now let's look at what would happen if Apple went up. If Apple goes up to say $200, then as the put buyer, you've got the right to sell at 145, but if you could actually sell at 200 on the open market, why would you want to exercise your put option to sell at 145? Nobody wants to sell for less than what they can get elsewhere. So this put option is what you call out of the money because the strike price is lower than the market price of the underlying, and it will expire worthless, and the buyer of that put simply loses whatever they paid to own that option, and they walk away with a $5 loss. For the put seller, it'll obviously be the opposite. If Apple goes up to 200, then the buyer of that put is not going to exercise their right to sell, meaning the seller of that put is not going to have an obligation to buy at the strike price. They're just not going to have to do anything, no obligation whatsoever. So they just walk away with $5 in their pocket, and that's it. So if the underlying stock price goes above the strike price in a put option, that put option is out of the money. And out of the money is bad for the put buyer because they'll just lose what they paid for the option. And out of the money is good for the put seller because they get to just keep the premium that they collected for the option and they just walk away with no obligations to fulfill. Let's summarize a little bit. The put buyer, their profit zone is if the strike price is higher than the market price of the underlying, because it's good to have the right to sell something at higher than what it's worth elsewhere. And it's opposite for the put seller. If the strike price is lower than the market price of the underlying, they walk away with no obligation and they get to keep the premium collected, resulting in their maximum profit. Buying a put is a bearish trade, meaning it benefits from the market going down, whereas selling a put is the opposite. It's a bullish trade, meaning it benefits from the market going up. I just said a lot here, but trading options basically boils down to this. There are only two types of options, calls and puts. And then there's only two things you can do with those options. Buy it or sell it. If you buy an option, whether it's a call or a put, you have to pay the premium, so it costs money out of pocket up front, and you're buying a right. If you buy a call, you're buying the right to buy. If you buy a put, you're buying the right to sell. The option buyer always has the right, and the option seller always has the obligation to take the other side of that trade, because the seller is collecting premium up front because what they're selling is they're selling an obligation. So now that you have a basic understanding of calls and puts, the real question is, what can you do with them? How do you actually trade them? What is the point? So when you sit down to trade options, you always start with something called the options chain. The options chain is a big matrix that lists all the calls, all the puts, and all the different strikes for all the different expiries for a specific stock. For example, here's the options chain for Apple stock. The underlying is Apple, and there's also a range of expiry dates to choose from. Let's say you went with August 20th. So if you click on the August 20th expiry date, that will expand it so that you can see all the different strike prices for that expiry date. Let's say you want to buy a 145 strike call option for August 20th expiry. Now option chains always show calls on the left and puts on the right. So if you want to trade call options, you would just stick to that left side of the table. So to buy a call option, you'd have to pay about $141. That's the premium or the cost of that option. As a side note, if you're actually going to trade this, even though it says $141 on the options chain, you'd actually be paying $141. That's because option prices are always expressed on a per share basis, but every option contract is actually on 100 shares. So whenever you're doing calculations, you have to multiply all your dollar amounts by 100. This is also known as the contract multiplier. So the key things to know about this option are, it's a 145 strike call option on Apple for August 20th expiry, and it's gonna cost you $141. At this point, if you decide to buy this call option, you'll be paying $141 in premium, or on the other hand, you can also maybe decide to sell this call option instead and collect that $141 in premium. Okay, so those are the different ways to trade options. With that, you've reached the end of this video. Congratulations. Thank you for sticking with me because I know it's a lot. Now, this is a pretty introductory video, but we've covered a lot for an introductory video, don't you think? All right, let's review. Stock options give the option buyer the right to buy and sell the underlying stock at a predetermined price, the strike price, by the expiry date. Calls give you the right to buy, puts give you the right to sell. For a call to be in the money, the strike price should be lower than the current market price of the underlying stock. For a put to be in the money, it's the opposite. The strike price has to be higher than the current market price of the underlying stock. Also, whenever you buy options, you have to pay the premium upfront, and whenever you sell the options, you collect the premium upfront. Now that you understand the 4 building blocks of options trading, buying and selling calls, buying and selling puts, you are ready to go to the next step, which is understanding how to put these building blocks together to make trades the safe and smart way to generate a reliable income. This video is the second in a 6-week series of options trading videos that I have coming up for you. Each one will build on the other, so make sure to subscribe and hit the notification bell so you don't miss any video in the series. Next week's video will be all about the best apps and brokerages for trading options, so you don't want to miss that one. I will see you there. And of course, don't forget to sign up for my free options trading starter kit to help you retain everything we covered in this video. That's it for today. I hope you found this helpful. Give this video a thumbs up if it demystified options for you at all, and check out my channel for more awesome content on how to seriously uplevel your financial literacy and live life on your terms. That's it for now. Thank you so much for watching. I will see you next week, same time, same place. Bye.